Hi everyone, welcome back. Now let's continue our discussion on the drawbacks of volatility or the drawbacks of modified duration. Like I mentioned in one of the previous lectures, modified duration assumes that the equation of the bond is actually a straight line which is in the form of y equal to mx plus c, where y is actually the intrinsic value of the bond, x is the YTM. All right. Modified duration actually assumes that the equation of bond is actually a straight line, which is y equal to mx plus c, with y as the bond price or the intrinsic value of the bond, and x is equal to the YTM or the required rate of return. And m was nothing but the slope, which was the volatility itself. The meaning of m was when x changes by 1 unit, how much does y change by? All right. So that was nothing but volatility, right? When x changes by 1%, how much does your y change by, or how much does your bond price change by? But if you actually carefully think of the bond price equation, can I write the bond price equation as IV of the bond is equal to cash flow 1 divided by 1 plus R or Y? Say R, I'm denoting R as the rate of interest or the required rate of return. CF1 divided by 1 plus R plus CF2 divided by 1 plus R the whole square plus CF3 divided by 1 plus R the whole cube. That is what you do, right? When we were drawing a table and calculating the intrinsic value of the bond, what we did was we multiplied the cash flow 1 with the present value factor for the first year, cash flow 2 with the present value factor for the second year. That present value factor was nothing but 1 divided by 1 plus R, 1 divided by 1 plus R the whole square, plus 1 divided by 1 plus R the whole cube, and so on. All right, so intrinsic value, which is Y over here, intrinsic value, which is y over here, is equal to cash flow 1 divided by 1 plus r plus cash flow 2 divided by 1 plus r the whole square, and so on. All right. Clearly over here, intrinsic value is y and r was what we called as x. If you actually notice over here, clearly this is not in the form of y equal to mx plus c, because in y equal to mx plus c, x has got a power of 1. All right, x has got a power of 1, whereas over here r or x does not have a power of 1. If you see, it's actually in the denominator, so it has got a power of -1, -2, and so on, right? So the actual true equation of a bond is not in the form of y equal to mx plus c. Modified duration or volatility was assuming that the equation of the bond is in the form of y equal to mx plus c, but the intrinsic value of the bond equation does not have x raised to the power of 1. It has got multiple, it's got x raised to the power of -1, x raised to the power of -2, and so on. All right, so it's clearly not in the form of an equation of a line. If we actually plot this equation on the graph, you're basically going to get something like this. It's actually not going to be a straight line. It's actually going to be a curve. All right. It's actually going to be a curve in this manner. All right. On the x-axis, we are denoting x, which is nothing but YTM. On the y-axis, we are denoting the intrinsic value. All right. X-axis, which is the independent variable, is the YTM. Y-axis, which is the dependent variable, is the intrinsic value, and the equation is actually in the form of a curve like this. All right. And let us say this black dotted line, whatever I've denoted over here, this is the current YTM. All right, this is the current YTM. On a scale of YTM, you can have 0, 1, 2, 3 to till 100, and so on and so forth, right? This is the current YTM. All right, you can think of it as any value, say 4%, and at 4% YTM, this is the current intrinsic value. All right, at 4% YTM, this is the current YTM, and this is the current intrinsic value. If the YTM goes if the YTM further moves to the right, which means if the YTM actually increases, the bond price is actually going to fall. All right, if you see, the bond price will actually be somewhere over here. All right, so if you move further to the right on the graph, which means on the x-axis, if you move further to the right, on the y-axis, your bond price is actually falling. Similarly, if you move to the left, on x-axis, then your bond price is actually rising. All right, your bond price is actually rising. Your bond price is rising from your current value to this particular value. All right, this was what we actually even saw earlier as well, right? When your interest rates increase, your bond price falls. When the interest rate falls, your bond price rises. All right, so this is how the graph of the bond equation actually is. It is a curve and not a straight line, which modified duration actually assumes. All right, moving further, like I mentioned earlier, let us say the current YTM is 4%, and this is where the bond price actually is right now. All right, this is where the bond price actually is. Now, what is modified duration actually doing? Modified duration is actually drawing a straight line. Modified duration is actually drawing a straight line, and it is assuming that the bond equation is actually this straight line, and it's drawing a straight line such that that straight line is a tangent. It is drawing a straight line in such a way that it is a tangent to the curve at the current YTM. All right, it is not a tangent at any other place. It is exactly a tangent at the current YTM of 4%. All right, so modified duration is drawing a straight line, and it is calculating the slope of this straight line, and it is telling how much is the bond price going to change by when the YTM changes by 1%. I'm repeating myself. What is modified duration doing? This curve, black curve, is actually the curve of the bond. Modified duration is drawing a straight line at the current YTM in such a way that it is a tangent. All right, modified duration is drawing a straight line which is tangent to this curve at the current YTM. All right, and it is calculating the slope of this line, and it is saying that the slope of this line is volatility, and it is saying when interest rate increases from 4 to 5%, your bond price will fall from this particular red dot to this particular dot. All right, your bond price is going to basically fall from the first highlighted row. Maybe let me actually just take another. Okay. It is saying that when the YTM actually increases by from 4 to 5%, the bond price is actually going to fall from the blue line to the green line. All right. So modified volatility is stating that when the YTM actually increases from 4 to 5, the bond price will actually fall from this blue line to this green line. All right. And that it has determined by calculating the slope of this line. Whereas if you actually see this, the bond equation is not this line, but it is actually this curve. All right, and when the YTM is falling from 4 to 5, the fall in the bond price is not from this particular blue line to this particular green line. It is actually falling only from that blue line to this violet line. All right, it is falling only till here. All right, it's falling from that blue line to this violet line. When the YTM actually increases from 4 to 5, the fall in the bonds price is from the blue line to the violet line, whereas modified duration is assuming that the fall is from blue to the green line. All right, and that is the reason I've denoted that this is the actual price at YTM of 5%, and this particular point is the price which is estimated by modified duration. And that is the reason when defining volatility or modified duration, I said when modified duration of 2.72% means when the YTM changes by 1%, bonds price approximately changes by 2.72 percentage. The modified duration does not actually give you the accurate change. The modified duration is giving you an approximate change. The actual change is actually given by this curve, which is actually slightly higher than what modified duration is actually giving. All right, and if you think of it in the same way, when the YTM is actually falling from 4 to 3, when the YTM is falling from 4 to 3, the price which is estimated by modified duration will be on the blue line. The price which will be estimated by the modified duration is on the blue line, whereas the actual price is over on the black curve. All right, the actual price of the or the intrinsic value of the bond is on the black curve. All right, so even for a fall in interest rate, modified duration is only giving you an approximate change in intrinsic value. It's not giving you an exact change or the accurate change in the intrinsic value. All right, what is modified duration doing? It is drawing a line which is tangent to the curve at the current YTM. All right, that tangent is exactly at the point where we are standing right now in terms of YTM. Wherever we are standing today in YTM, the line is actually exactly tangent to the curve at that particular point, and modified duration is calculating the slope of that line. All right, whereas the actual price, all right, the actual price is lying slightly higher. In case of a fall in interest rate or in case of a rise in interest rate, the actual price is actually is higher than what is there on the straight line. The actual price is higher than what it is there or what is being estimated by modified duration. All right, this gap is what we are now going to further estimate. All right, this gap is what we are now going to further discuss about. All right, now, but before we go over there, let's actually quickly go through the notes. We have seen that the equation of bond is not a straight line, but it is actually a curve. And this curve is a convex shaped curve. And that is the reason we have used the word convexity. All right, it's a convex shaped curve. In your science of 7th class or 6th class, you might have learned two shapes: convex, concave. If you don't remember by heart that this is a convex curve, and therefore we have got the word convexity. All right, apologies. When the YTM is increasing by 1% from 4 to 5, the actual change in price is captured by the curve. Modified duration is assuming a straight line at the current YTM, which is tangent to the curve, and that is only providing an approximate change in the price. All right, modified duration is providing the green line as the change in price, whereas the change in price is captured by the violet line. The actual change in price is the violet line. All right, and this approximate change in price, which is calculated by modified duration, is below the price. It is below the price which is indicated by the curve. The curve is actually the curve is standing slightly higher than that line. Whether there is a fall in interest rate or a rise in interest rate, the curve is actually above the line. All right, so modified duration is always underestimating the price. The curve is actually above the line, and modified duration is underestimating the price, whether for an increase in interest rate or a decrease in interest rate. All right, so this is true for both decrease and increase in YTM. So now, to find the exact change in price, we are going to capture that gap, which is called as convexity adjustment. All right, we're capturing that gap, which is called as convexity adjustment. And now, if I capture that convexity adjustment, the change in price is equal to negative modified duration multiplied by delta y. If you carefully see, this particular portion was what we were doing earlier. All right, negative modified duration multiplied by delta y. Earlier we were saying that the change in price is equal to minus md into the change in YTM. Now we have added this extra term, which is half into convexity into the change in y square. Half into convexity into the change in y square. Change in y is nothing but the change in YTM. All right, let us say if the interest rates change by 0.5 percentage, then this delta y is nothing but 0.5. All right, if interest rates change by 0.3 percentage, this delta y is nothing but zero point 0.3. Delta y square is nothing but 0.3 square. All right, the delta y is nothing but 0.3 square. All right, and therefore we have got an additional term that we have to discuss, which is called as convexity. All right, we have got an additional term which is called convexity over here. All right, so previously modified duration was saying that the change in price is equal to minus modified duration into delta y. All right, it was saying minus modified duration into delta y plus half into convexity into delta y the whole square is the additional term that we are introducing to capture this gap. All right, to capture this gap, we are actually introducing that additional term. And if you carefully look at it over here, I actually used minus, but for the second term I did not use minus. I'm only using plus. Reason being, I always want to increase the price. Right over here, if you carefully notice, the price always which is actually on the curve is higher than what is there on the line. So for that, I'm always doing a plus. It will never be a minus. I'm always actually doing a plus itself. All right. So half into convexity into delta y the whole square. All right. In my example that I was saying, zero point 0.3 whole square will actually be equal to 0.09. All right. Zero point 0.3 whole square will actually be equal to 0.09 whole 0.09. Now, how do we calculate convexity? Before we discuss on how to calculate convexity, I had given you a formula for modified duration at the end. All right, I'm not talking about method 1 or method 2. I gave you a formula for modified duration as summation t equal to 1. I'll just probably scroll up. Modified duration is equal to summation t equal to 1 to n T into discounted cash flow, the whole divided by IV0 into 1 plus YTM. All right. T into discounted cash flow for each year, 1 into discounted cash flow for first year, plus 2 into discounted cash flow for second year, plus 3 into discounted cash flow for third year, the whole divided by IV0, again further into 1 plus YTM. All right. This 1 plus YTM is also in the denominator. All right. This was the formula for modified duration. You're going to see that convexity is also a little similar. All right. And the reason why I put this formula is so that you're able to relate convexity formula also in the same context. All right. I have shown convexity in the form of a formula over here, and I will also show it as a how we calculated modified duration using a tabular form. I will also show how to calculate convexity using a tabular form. Convexity is going to be summation t equal to 1 to n, and it's going to be t into t plus 1 into discounted cash flow for the respective year. All right, I will rather add discounted cash flow for year t. All right, discounted cash flow for year t. What do I mean by this? First year cash flow, multiply it with 1 into 1 plus 1. Second year cash flow, multiply it with 2 into 2 plus 1, which means you will do 2 into 3 into the second year cash flow. All right. Third year cash flow, you will do 3 into 3 plus 1, which means 3 into 4 into discounted cash flow for the third year, the whole divided by IV0 into 1 plus YTM, the whole square. All right. So what has got added is to to the duration formula, this is one extra term that has got added, and in modified duration you had divided by 1 plus YTM. Over here you have got 1 plus YTM the whole square. All right, so modified duration formula was summation t equal to 1 to n, T multiplied by discounted cash flow for the year, for the respective year, the whole divided by IV0 into 1 plus YTM. Over here, convexity is equal to T into T plus 1 multiplied by discounted cash flow for the respective year, the whole divided by 1 plus the whole divided by IV0 into 1 plus YTM, the whole square. All right, so two additional terms that are added is T plus 1 in the numerator, and in the denominator we have got another 1 plus YTM which is getting multiplied. All right, so that is, since it's getting multiplied again, we are calling it as 1 plus YTM the whole square. All right, so this convexity number we are going to actually multiply it with delta y the whole square into 1 by 2, and that is going to help us determine the change in price. All right, in the next lecture, I will take an example with you guys where I will actually calculate modified duration and convexity, and we'll actually see how the price changes for what is the price estimate that modified duration is doing, and what is the price estimate that convexity is actually doing. Although we are not going to discuss much in further detail about it, after adding the convexity adjustment also, you are not going to get exactly the violet line that we actually have over here. All right, you're not going to exactly have the violet line that we are going to get over here. There's still going to be a very, very, very small difference between the actual curve and what we are estimating using convexity adjustment, but that gap is so minuscule. All right, the gap between modified duration price versus versus the actual price is quite significant. All right, the gap between the price estimated by modified duration and the curve is actually quite significant, and therefore we introduced convexity. After introducing convexity adjustment, are we estimating the absolutely accurate price on the graph? The answer is no. The price that we are estimating, even after taking into account the convexity adjustment, is still an estimate itself, but it is very, 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 very close to the purple line that we have over here, or the violet line that we have, and therefore we are ignoring the differential. All right, we are saying that the price which is estimated after the convexity adjustment is as good as the price which is there on the curve itself. All right, I'm not going to get into further details about it because that involves derivatives. All right, not derivatives meaning not the derivatives that you have in SFM, the d by dx that you had in mathematics in your 11th class, which you left probably ages ago. We will have to introduce that d by dx for me to make you understand that, which I'm obviously not getting into in further detail. All right, so in the next lecture we're actually going to see how to actually calculate modified duration, convexity, and that is further going to help you understand why we are saying modified duration is only an approximate change. You will understand it through numbers. Over here I made you understand it through the graph. In the next lecture you will see it through the numbers. All right, that's it for this lecture, guys. Thank you. Bye bye.